Meme stock craze is back. GameStop and AMC are soaring again, but Wall Street says this time may be different. Joining us now with more on why this surge isn't like that 2021 meme stock craze is Yahoo Finance's very own Josh Schafer. Joshua.
Yeah, guys, so that's sort of been the prevailing take from different Wall Street strategists, both that we've spoken with and just people producing research on the street that we get into our inboxes here, sort of breaking down overall. It doesn't quite feel like 2021. And there's a couple data points we can highlight with that. So Vanda Research took a look at just retail net inflows that you see into these stocks, right? And when you take a look at Monday, we saw 15.8 million into GameStop, 37.5 million into AMC. When you compare that to 2021, in the peak of 2021, we saw daily inflows into GameStop of 87.5 million. So that's 87.5 million compared to 15.8 million. That is a big, big difference. With AMC, we saw about 170 million, and that's compared to 37.5 million. So quite simply, the flows aren't anywhere close to what we saw back in 2021. And then there's a couple just broader points that people have been bringing up too that I think are sort of rather intuitive to think about here. One of them just being, it isn't 2021 in the world anymore. And so maybe that's why this isn't going to last longer than maybe the 36 hours that it's lasted.
Meaning in 2020, people, pandemic, stuck at home looking for some fun.
We're not sitting at home, hanging out.
Extra cash.
Watching a live
that's another
stream.
point. Stimulus checks.
And there's not the stimulus checks that just came. It's just not the same environment. And so when you think about how that maybe plays out in the market, again, maybe people don't just have the money to throw at something like this and the time to watch what the money's doing.
Well, and it's not just about the people who are trading, the retail traders who are trading this. The world has also changed in that hedge funds have wised up. At that time, you know, the Gabe Plotkins of the world were really caught off guard by the force of this, you know, phenomenon. Now they're probably following, at least some of them are, you know, following along with it. And yes, there were some then who were doing that too, but they've wised up to this.
Yeah, no, the positions aren't nearly the same, right? For the level of a short squeeze that we saw, there isn't that kind of room to run when it comes to that. And you're right, Julie, a lot of people have been pointing out to, if flows are working how they think right now, hedge funds are probably actually benefiting from this and sort of getting in on the trade. And perhaps maybe when you look at these stocks now, significantly off their highs of the day, maybe already getting out of the trade, right? Because the stocks move pretty quickly. And the other thing too with that is investors maybe have just gotten a little bit smarter too. We're not seeing the level of leverage in the market that we saw at a time like 2021, or we saw in prior bubbles. This is something that we've been talking about a lot in the bubble conversation that for some reason we started having over the last 2 months. But capital economics kept pointing to leverage in the market. And there's this graph you see, leverage in the market usually shoots up around the dot-com bubble. It shot up around the great financial crisis. And it even shot up in 2021 about in line with where stocks are. Here's the chart here. Your purple line there, for a high level, we can call that leverage in the market or people using margin to trade.
Right.
And that is not nearly as closely correlated as the S&P 500 chart. And so when you take a look at that, it basically is just telling you that level of risk that people were taking in prior moments isn't quite happening right now.
Good.
Really interesting.
Probably good, yes. Probably overall a good thing, I think, for everyone involved.
Thank you, Josh. Appreciate it.